In 3 days, one of the most important events in the entire history of Wall Street is about to happen, and hidden inside it, quietly, almost invisibly, is a trigger that could send one particular Elon Musk stock into a completely different orbit. Most investors are watching the wrong thing. They're staring at the big, shiny spectacle in front of them and completely missing what's happening in the shadows behind it. This is a story about timing, about a merger rumor that Wall Street hasn't fully priced in, and about why Tesla, a stock that's been cold, dismissed, and overlooked in 2026, might be about to shock every single person who gave up on it. Stay with me, because this setup doesn't come around twice. Let's set the scene right now. The financial world is in the grip of one of the most extraordinary IPO stories in modern history. SpaceX, Elon Musk's rocket company, is preparing to go public on June 12th, this week, in a matter of days, and not just any IPO. SpaceX is targeting a valuation of $1.75 trillion. That would make it the 7th most valuable publicly traded company in America. Before a single share has traded on the open market, they're trying to raise $75 billion in a single offering, more than most countries' sovereign wealth funds hold. Goldman Sachs is leading the deal. Morgan Stanley, Bank of America, Citi, JP Morgan, they're all lined up. 555 million shares priced at $135 apiece. The biggest IPO in history. And everyone is watching it. Every hedge fund, every retail investor, every financial news outlet on the planet has their eyes locked on SpaceX. But here's where things get strange, because buried inside SpaceX's SEC filing, in quiet, almost throwaway language, there's a sentence that barely made the headlines. A sentence that Wall Street's smartest readers immediately noticed. And a sentence that changes the entire conversation around one very specific stock. The filing says this: SpaceX may issue a significant amount of equity in a connection with future transactions. Now, at first glance, that sounds like standard boilerplate. Every company going public says something like that. But this is different, because financial journalist Sean Tully at Fortune was one of the first to flag exactly what those words might mean. When you pair that sentence with everything else Elon Musk has been doing, the implication becomes impossible to ignore. In late May, CNBC reported that Musk had been privately discussing one of the most audacious deals in corporate history with colleagues, a merger between SpaceX and Tesla, two companies, one Elon Musk entity, combined value over $3 trillion. Think about that for a second. $3 trillion company, led by one man, encompassing rockets, satellites, electric vehicles, autonomous driving, artificial intelligence, and energy storage, all under a single ticker. And yet, Tesla, the stock that would potentially be absorbed into this empire, has been down roughly 3% this year, sitting around $408 on Monday. Institutional investors have been rotating out. Analysts have been cutting estimates. The mainstream narrative around Tesla in 2026 has been grim, but this is where the story changes. Because while everyone was writing Tesla's eulogy, Musk was apparently drawing up blueprints for the most transformative merger in the history of American business. Let's understand what Tesla actually is right now, because most people are still using a 2022's mental model to judge a 2026 company. Tesla started as a car company. Most people still think of it that way. And in that framing, yes, the story looks disappointing. EV sales have been sluggish globally. Competition from China's BYD is relentless. The legacy automakers finally woke up. Margins have been compressed. Tesla recently announced it would discontinue the Model S and Model X. On the surface, it looks like a company in decline. But here's what the narrative misses. Tesla isn't really a car company anymore. It's a platform. Think about what Tesla actually controls. It has the world's most advanced autonomous driving software in full self-driving. It has a Robotaxi service already live in Austin and San Francisco. It has the largest fleet of data-collecting vehicles on the planet, training AI models in real time every single day. It has energy storage through Megapacks, a business growing faster than the vehicle segment. And it has Dojo, its custom AI supercomputer, quietly processing all of that data. In Q1 2026, Tesla beat EPS estimates 0.41 cent versus the 0.39. Wall Street expected earnings were up 17% year over year, and Elon Musk, speaking in Tel Aviv in May, said that fully self-driving Teslas would be probably widespread across the United States by the end of this year. That's not a car company. That's an AI company with wheels. And now, potentially it might be absorbed into a company that controls the orbital economy of Earth. Here's the bull case for Tesla, and why the next 6 months could be violent to the upside. First, the SpaceX IPO itself is a catalyst, even before any merger discussions become official. Just the conversation around a potential Tesla-SpaceX combination is already moving Tesla's stock. On Monday, June 8th, Tesla jumped nearly 5% in a single session. Not on earnings, not on a product announcement, on the rumor of a deal that hasn't even been confirmed. That kind of price reaction tells you how much suppressed energy exists in this stock. Second, think about what a merger would actually mean for Tesla shareholders. SpaceX is going public at $1.75 trillion. Tesla currently has a market cap of around $1.4 trillion. If a deal is structured where Tesla shareholders receive SpaceX equity even partially, the implied valuation of a combined entity would be extraordinary. Fortune calculated it. A combined Tesla-SpaceX would be worth somewhere north of $3 trillion. That would make it the fifth most valuable company in America, overnight surpassing Amazon and Microsoft in one move. Third, and this is the part that gets lost, SpaceX its XAI unit just purchased $269 million worth of Tesla Megapacks in April 2026 alone. This comes after SpaceX bought $430 million worth of Tesla energy storage products last year. These two companies are already deeply integrated financially. The deal isn't hypothetical. It's already happening, transaction by transaction. The formal merger announcement would simply be the official acknowledgement of something that's been quietly constructed for months. Fourth, autonomous driving. Musk has repeatedly said Tesla's future hinges on robotaxis. The service launched. It's expanding. And if FSD reaches widespread commercialization by year-end, as Musk predicted, this company's revenue model transforms completely. It goes from selling cars to selling miles. From a hardware business to a recurring software income stream. That is a multiple expansion story, unlike anything the market has priced in. So why hasn't the market fully responded? Because Wall Street analysts are still using last year's framework. The consensus view on Tesla is essentially this: EV demand is soft, margins are under pressure, competition is intensifying, and Musk is too distracted. When you plug those assumptions into a traditional automotive valuation model, you get a price target in the 200s, 300s, and a lot of sell recommendations. But that model is fundamentally broken for what Tesla is becoming. Here's the disconnect. You cannot value a company that controls an autonomous driving fleet, an AI training platform, a battery energy storage business, a robotaxi network, and potentially the most valuable space company in history using a price-to-earnings multiple designed for Ford or General Motors. It's like valuing Amazon based solely on its retail margins in 2005 and missing the entire cloud story. The analysts who are bearish on Tesla today are making a category error. They are looking at the hardware and missing the software. They are measuring the car and missing the AI. They are reading the quarterly earnings and missing the merger premium that's been building silently for months. And the SpaceX IPO this week is the event that could force the market to reprice all of it at once. Now, and this matters, let's be honest about what could go wrong, because there are real risks here, and ignoring them would be foolish. The merger is not confirmed. It is a rumor. CNBC reported that Musk discussed it with colleagues. There is no official announcement, no signed term sheet, no shareholder vote. This could be posturing, deal theater, or simply Musk thinking out loud. If the merger never materializes, a significant part of the recent stock price move evaporates with it. Second, even if a merger is pursued, the mechanics are brutal. These are two enormous companies with different shareholder bases, different governance structures, and completely different businesses. Valuing them against each other, figuring out the exchange ratio, managing the regulatory process is extraordinarily complex. And that assumes Musk can get Tesla's independent board and minority shareholders to agree. Third, one analyst from Morningstar has already gone on record saying SpaceX's IPO valuation of $1.75 trillion is roughly double what the company is actually worth. Their estimate puts fair value at $780 billion. If SpaceX opens below expectations, or if the IPO hype fades after the first week of trading, the merger narrative loses oxygen fast. Fourth, Tesla itself still has operational risks. EV margins remain thin. Robotaxi expansion is slower than promised. Capital expenditures are surging. Tesla raised its 2026 capex forecast to $25 billion, up from $20 billion. That's a lot of cash going out the door. And fifth, Elon Musk. himself is both the biggest asset and the biggest risk. His attention is split across Tesla, SpaceX, XAIX, and Neuralink. One controversial tweet, one political headline, one Musk-induced distraction can move this stock 10% in either direction overnight. These are real risks. They deserve respect. But here's what keeps coming back to me when I look at this setup. 3 days from now, the biggest IPO in American history goes live. A company that Elon Musk controls with over 82% of the voting power begins trading on the NASDAQ, and inside the filing for that IPO, there's a quiet sentence about issuing equity for future transactions. There are already hundreds of millions of dollars flowing between these two companies. There are reports of private merger conversations. There is a Tesla stock that jumped 5% in a single day on nothing but whispers. The market is telling you something. Maybe it's pricing in a deal that never comes. Maybe Wall Street is right. Maybe this is just noise, just hype, just another Musk headline that fades by the weekend. Or maybe this is what the setup looks like just before something transformative happens. The investors who loaded up on Tesla when it was $165 in mid-2024, when the headlines were just as bearish, when analysts were cutting targets, when everyone had given up, those investors are sitting on returns of nearly 2.5 times their money today. History doesn't repeat, but in markets, the psychology does. A dismissed stock, a catalyst that nobody fully understands yet, a founder building an empire piece by piece, deal by deal, filing by filing, while the crowd watches the spectacle and misses the play hidden inside it. Maybe the merger doesn't happen this year. Maybe it doesn't happen at all. But this week, as SpaceX begins trading and the world finally prices Elon Musk's full empire for the first time, Tesla sits at a crossroads. And the investors who do their homework before the crowd arrives are usually the ones who tell the story later.